Student loans aren't broken. They haven't spiraled out of control or gotten hijacked by greed. They were designed this way, and they knew that this is the future they would create. Because if student loans were meant to be paid off, they wouldn't be able to trap borrowers for decades. And to understand how we got here, we have to go all the way back to when student loans weren't a problem at all. For most of American history, college wasn't financed with debt. Public universities were heavily subsidized, so the tuition was low. Many students worked part-time jobs to pay their way through school. In the 1960s, a summer job could cover most of a year's tuition. Now, college was never cheap, but it was reachable. Higher education was treated as a benefit of public good, not as a personal financial gamble. But that model didn't last for long. In the late 1950s and early 1960s, the federal government stepped in, and their idea was simple. If more people could afford to go to college, the country would benefit from a more educated workforce. So, the government began guaranteeing student loans. Banks would lend the money, the government would absorb all the risk, and at the time, this seemed reasonable. The loans were small because tuition was low, and most borrowers would be able to pay them off quickly by the time they graduated school or a few years later. But one change quietly altered everything. The risk disappeared. When lenders stopped bearing risk, they stopped caring about affordability. And in 1976, another major shift occurred. Student loans became nearly impossible to discharge in bankruptcy. This means that the debt follows borrowers for life, no matter what happens. If you lose a job, if you get sick, if there's a recession, there is no escape from student loans. And from that point on, they stopped behaving like assistance and became an obligation without any expiration. And once this money became unlimited, prices stopped being constrained. Universities realized that students could borrow more, so tuition rose. Then it rose again, and again, and again. Not because education suddenly became more expensive, but because easy credit removes discipline. Luxury dorms have replaced basic housing, the administrative staff has exploded, and the fees have multiplied. Students and their families have absorbed this cost, and the institutions absorb it in cash. Because the debt lived in the future, the damage isn't immediate. And at the same time that all this was happening, the loans themselves changed. Interest compounded daily. Deferrals and forbearance didn't pause balances, it inflated them. Borrowers had the ability to make payments for years and still owe more than what they started with. It wasn't mismanagement, it's simple arithmetic. A system where time matters more than effort. And failure is no matter to the system. In a normal market, failure hurts lenders. In student lending, failure is irrelevant because the government is guaranteeing payment, so the lenders are getting paid regardless. That means defaults don't signal a problem, they're just paperwork. The borrower bears all the risk, the institution keeps the reward, and that's not accidental, it's structural. And this isn't about irresponsible students. Even if every borrower chose the perfect major, the perfect school, followed every rule, and got a perfect job, the outcome still wouldn't change. Because the system rewards higher prices, protects lenders, and locks borrowers into permanent obligation. That is not education policy, it's debt engineering. The average age to sign a student loan is 17 years old. Most high schools don't teach about compound interest, don't teach about long-term debt, so no one really understands the consequences, and yet these are the most sacred contracts out of any loans you can take out. The alternative is exclusion from opportunity, so the choice becomes an illusion, and that's why it feels like a betrayal. Because the rules were never explained honestly. And a lot of people see this and they think that student loans failed. But they didn't. They were just scaled. They created predictable outcomes, guaranteed revenue, and lifelong borrowers. They were never meant to be paid off. They were meant to be lived with, and that's why they don't tell you it. Because if you knew that you were entering into a contract that you would have to be paying off the next 50 years of your life. You would never do it no matter how young you were, but they allow you to because you don't know any better. Thank you for watching The Hidden Media.